Cost segregation we're going to talk about. Mark, I'll do this slide if you're okay. So what is cost segregation? I use the Big Mac analogy. And Julie, stay with me.
Okay.
You might be old enough to get this. Um, I use the Big Mac analogy on if I'm to describe a Big Mac, I can use straight line depreciation methodology to describe it and call it a hamburger, right? It's just all one piece. I'll call that a hamburger. But if I were to use a cost segregation methodology to describe that Big Mac, what would I call it? Julie's too young. So Jay knows this. So this was a commercial about 40 years ago where every kid in America knew the jingle. 2 all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun.
I got that.
Yeah, there you go. So it's so usually what happens, Julie, when I do this in a room, all the millennials turn their head at the person that just did what you did, and they go, "Where did that come from? What the hell?" So as kids, we all knew that. But cost segregation method is looking at a building in its parts and pieces, and the cost segregation specialist looks at the building all throughout it and identifies all the parts and pieces that you're able to depreciate in the first year. So Mark, I'll let you roll on with a description of cost segregation. I'll let you go through some of these slides if you would, please.
Sure. One thing we need to identify is the fact that what CPA will typically do is a straight line depreciation for multifamily or residential properties. That's going to be your 27 and a half years. For all of your other property types, that's your 39 years. That's the third bullet point there. And the other thing to keep in mind is that when and we'll show you a graph later which will depict this, when you look at what your depreciation costs are, what you're basically doing is front end loading a lot of your depreciation costs. So if you were to hold the property for the entire period, you're still going to be paying the same amount, however you're going to be paying it with less expensive dollars, and also looking at what the time value of money is. And that again is the second part of the third point there. So how much can you save on a cost segregation study? Well, the range might be from $30,000, $80,000 per $1 million in what you paid for the property. And one thing you need to exclude, of course, is whatever the land value is, because land cannot be depreciated. And what we typically say is that we'll do it for buildings which are $350,000 or greater in cost, and also take a look at what the TI tenant improvements might be as well. Return on investment, typically 10, 30 times. Sometimes it's going to be lower on lower properties, or I'm working on one in Connecticut right now where it's actually going to be a little bit less than that. But the problem with that is that the CPA didn't recommend that the owner do a cost segregation study on it. He's actually owned it for 5 years already, and now he wants to have one done. Well, we can still make it very advantageous for him. However, it's advantageous to do it the first year that you acquire it to retain the most benefits possible. Anything else you want to add on that, David?
No, you're good.
I do have a question on that before you go. How soon after you close do you need to do a cost segregation? Is it within the first year? Let's say if we're buying it in November and I want it for 2021, when do I have to have that cost segregation done?
You want to do it before your taxes are completed. Now, the thing that some people are under misconception that if you're buying it in 2021 that you have to have the study done that year. That's not correct. You just have to have that completed prior to when your taxes are filed. Now, we have a lot of our clients that actually extend their taxes. They don't do it in the springtime, they do it in the fall. And what that does is extends that period of time. So you could actually buy something toward the end of 2021 and not actually have the study done until later in spring or summer in time for fall. Now, I will point out that we get incredibly busy prior to tax seasons and they get backed up. So I wouldn't suggest that anybody procrastinate and not do it early, but it doesn't have to be done in that calendar year.
But keep in mind, your investors want to get that done. They want to be able to file their taxes. So you're holding them up. That's not looked at as favorable. So if you can get this done before April 15th, I would highly recommend it.
Yeah,
You're in good standings with your investors.
I agree. Most of the other ones that are extended, at least from my experience, from my clients, they're ones they're single investors, and it's not as big a deal for them. But your point's well taken.
Yeah, and Julie, I'll echo that. So if you have a building that you haven't done cost seg and you want this done for next year's tax returns, start late October, November, December to get this done. So in January, you've got the results, and therefore you can apply those for your March 15th deadlines or April 15th deadlines. So really, we're coming up on a period of time. Now's the time to start taking action if you want it for early 2022, I guess.
Yeah, because you don't want to give it to your CPA or tax professional at the 11th hour, because they need time to be able to get that information applied toward the taxes, and they're busy enough with other things. So